If you are somebody who is looking to gain a leveraged position into a stock that you like for the long term, but you do not have the capital for it, we are going to be teaching you about what is called a leap option. So in today's video, we're going to break down leap options, how they work, how you set them up, and what is the overall purpose of them. So if you are excited for today's video, as always, make sure you like the video, subscribe to this channel, and as always, turn those bell notifications for all future uploads. This is day 1 of 7 days of options trading here, and today we're starting off with the basics, which is called leap options. Now, if you're not familiar with what a leap option is, leap options are long-term equity anticipation securities. Say that 5 times fast. But leap options, basically, I always look at it as in like you're leaping into the future. You are looking at a further dated option contract of your stock that you're looking for here. So I will bring up an example here. I'm going to break it down from start to finish. One of the examples that I would like to go through would be something like Microsoft. Why Microsoft? Microsoft has had a big pullback in the year so far, down 23%, almost as down as 26%. In the last year or so, it is now down about break even, which again, people love Microsoft. They're a company that's been for the future. They have Copilot, they have Xbox, Game Pass, stuff like that. They have Office, like you name it. Microsoft's got a lot of amazing things here. People love it. They have a really good dividend payout, for example. And you are looking at getting into a leveraged position with Microsoft. Again, we say leveraged here because leverage is what options provide to you. Bearing you know exactly how options works, they could put you in a good leverage position. So, for example, if I was somebody who wanted to buy up 100 shares of Microsoft, it would cost me $37,340. If I wanted to go over here and type in, 100 shares, look at that. That is an insane amount of money that majority of us, myself included, don't just have lying around to buy up 100 shares of Microsoft. So the question is, well, Fridge, how can I get 100 shares of Microsoft without having to put up this much capital? And this is where leap options and options in general create leveraged opportunities for you. So you're going to go over here to where it says trade Microsoft options right above my, nice silhouette here. And what you're going to see is you're going to see the options chain. Now, the options chain trades on what's called contracts. And each contract is equivalent to 100 shares. Okay. So that's why instead of buying 100 shares for $37,000, these contracts give you access to 100 shares at a much cheaper price. You're able to control 100 shares worth at a much cheaper price. So what you'll see up top here, and again, if you're not familiar with the options trading strategies here, we're going to be doing a lot of them over this week that I have off for spring break. You can also take a look at previous videos, but now these are more updated videos and newer videos and better ways that I can hopefully explain it for you here. So feel free to take a look at that. Obviously, Fridge Financials channel. It is all there for you completely free of charge, of course. So if you wanted to be on Robinhood, for example, they have a builder where you can take a look at how you could build options yourself. If you want to look at some strategies there, that's over there as well. What you have to become familiar with is this top part over here, over there. Yeah, that one. Okay. You have buy, sell, call, put, and you have expiring, and you have a date. Okay. So buying is obviously like you're the one paying for it. So you'll be spending money on a contract. You'll be buying a contract. The opposite of a buyer would obviously be a seller. Right? As if you need to buy something from a store, you have someone that sells it to you. It's the same thing with the options chain, same thing, right? You have a buyer, you have a seller, okay? So when you're buying, you're going to be paying that money up front. When you're selling, you'll be getting paid that much money up front. And we'll talk about selling options in a different video. Do not worry. You also have a call and you have a put option here. A call basically means that you are being bullish on the stock and you're thinking that's going to go up to a certain strike price. Put means you are being the opposite. You are being bearish, so if I buy a put option, I'm betting for Microsoft to go down. If I buy a call option, I'm betting for Microsoft to go up. And the most important thing for leap options here is the expiration date. This is what allows you to have control or access to 100 shares of a stock without having to pay the full amount for it. Okay, so leap options typically go for at least a year. I do mine a little over a year out. You can go as far as 3 years if you want to. If you go all the way down here, you can go right now to, about almost, that's about like 2.5 years, it looks like about. You go about like a little over 2.5 years if you want to for Microsoft, and that'll be 985 days till expiration. Now, things to keep in mind about, as you push the expiration date further out, it will cost you more money. That is something to keep in mind about. Okay, so if you're looking at December 15th, 2028, which is again is 985 days away, you were looking at paying a juicy premium. You're looking at paying a good amount of money for this one because of how expensive it's going to be. But again, your typical leap option, anything after, anything around like June 2027 onward would be considered a leap option in the stock market game. So let's say we go to December 17th of 2027. And again, Microsoft has had a big pullback recently, and you're like, Fridge, I think it's bound to recover. And I'm like, you know what? I get that. I completely understand. Microsoft's a very good company, very high-paid dividend company, Mag 7, like you name it. Like there's so many good things about the company overall, right? So you want to buy a call option. Now, as you will see, the share price right now is at $373.40, okay? And when you're buying a call option here, you have to keep in mind what's called the strike price. You have the strike price, which is basically what you're looking for to go up to break even. You also have the price you're going to be paying per one share of it. Keep that in mind. This is how much you're paying for one share of Microsoft. And again, it's in contracts, or it's in the contract is 100 shares worth. So you take what you pay and you multiply it by 100 times. So if you paid, $6,000, you'd be paying, or if you paid $60 per share, it'd be $6,000, for example. All right. So let's say that, you think Microsoft is going to be, have a big move to the upside. I don't know what the all-time high was recently, but say, Fridge, I think it's going to be a $500 contract right here. So you'll be able to open up this position here. Now, this will cost you, as you'll see, $2,800 here. Okay. So keep that in mind. And this is a trade where this is a leap option, but it's a far out of the money. You might see it as an OTM, a far out of the money option here. Why? Because right now it's at $373, and you're expecting it to go to $510 or $500. Sorry. And what's even more interesting that you have to keep in mind about is if I can move this down a little. Let me move my head out of the way here really quick. Slide over. Whoop. So what's really interesting that you'll see is that actually the break even is $528.10. Okay. Now saying, Fridge, why? You paid $500 for the strike price, which I did. But again, you have to factor in your break even is going to be your strike price plus the premium that you pay up front. So instead of it actually going to $500, you would actually still be out all of your money. And as it climbs to $528, you are now break even. And then after that, anything after that is pure profit. But as you'll see, again, you are basically controlling 100 shares worth of Microsoft at $500. If it goes past that 528 break even, because obviously you had to pay for that, anything past that, you are getting that very, very nice leverage position of it. You are controlling 100 shares of Microsoft at $2,800 at a $500 strike price. But again, it's not there. So what I like to look for when looking at options contracts is looking at the delta for sure. This delta is 35, which means for every dollar Microsoft moves, this option will move up about 35 cents. Okay. Open interest is a good thing to look at for sure. Volume, bid-ask spreads. These are all really good things to take a look at as you're looking at your contracts here. As you will see, your implied volatility is going to be relatively low because you're so far out. They're not going to get a big move. This might spike a tiny bit when it comes to earnings for Microsoft in the future, but this is going to be relatively low. As you get closer and closer, your IV might ramp up a little bit as you get closer to that expiration date here. So if I'm looking at someone who's buying a leap option on Microsoft, I want to basically have it as almost a one-to-one control. So if Microsoft goes up $1, I want to go up 70 cents for my contract or 80 cents, which would be even better, obviously. But again, the deeper contract you go, the higher the delta, the more you pay for it. So as you will see here, right, when we look at this leap option here, this is what's called now in the money because you are already below the current share price. So you have out of the money, which is up top. You have in the money, which is down below in here. So anything below 373.40 is considered to be in the money because obviously the share price is already above your strike. But again, keep in mind, your break even is your strike price plus the premium that you pay. So even though you're like, oh, this is free money here, it's actually not because your break even is actually at $442. Take your strike price plus how much you pay. That gives you the break even of $442. Microsoft is not there. It's at $373. So that's something to keep in mind about. But as you will notice, this delta here of 0.65 means for every dollar Microsoft moves, I will be able to have this contract move up 65 cents of the dollar, or about 65% of the move that Microsoft gets, this option contract will get for us. So what I look for a delta, again, it's like 70 to 80, something like that. One of the ones that I think I would really like to get into if I was to open this trade here, which again, this is not financial advice, of course, this is just breaking down leap options here, is the 320 here. Why? Because the delta is about 77. So that means that for every dollar Microsoft moves up, this contract will go up 77 cents. And what I like about this as well is that your break even, so you're looking at 320 plus $100 because you're breaking even to 420 bucks here. Microsoft needs to move 12.5% to break even in a matter of, a year and a half. A year and a half for a Mag 7 to move 12% is not super unlikely. It's actually not a bad chance of that happening here, right? It can move 12% in 1 year. You're looking at 1.5 years in this case here. And so again, taking a look at the bid-ask spread, again, you got to make sure you get filled at a certain price because you're further out in terms of your contract here. But again, your delta is pretty good here. And what this is telling me is that I basically am getting access to 100 shares of Microsoft at 320 for $10,000 here. Okay, it's a $10,000 trade you'll be looking at getting here. But instead of buying 100 shares right now for $37,000, I can get access to 100 shares for $10,000. And as long as it goes up to 420, anything after that is pure profit. Now, again, you can go further out and say, Fridge, well, what if I want to go even further out? You definitely can. You can go way further out if you want to. But again, as you will see, as your delta increases, your price you're paying is going to increase as well. If you went to a 250, for example, your break even is like 6.5% right here. It's going to cost you $14,000. But even still, it's going to cost you $14,000 instead of buying 100 shares at $373. So you're still getting a discount of way more than 50% less, which to me, I think is amazing. Why would you not want to do that? So again, and the thing to keep in mind about is how much money you have in this case here. And again, the more money you have, the more you can get a deeper in the money leap option, for example. But again, if you're sitting there saying, well, Fridge, I can't do this with Microsoft, for example, it's like, okay, well, let's look at some other companies, right? We can go to another company, for example. Super Microcomputers is one that I still have liked, even though they had the big pullback because of the, scandal of, illegal, smuggling of parts and stuff like that over in China. Again, I like Super Micro as an overall value play here. So if you go to trade Super Micro computer options here, you go to SMCI options, same option chain here. Nothing is different in this case. And again, you look at $23. If you came to afford $2,300, that's okay. $2,300 here would be 100 shares worth. Let's say you want to go further out into a leap option here. Same expiration like Microsoft. You can get access to, again, looking at like a 73, 75 delta around here, you can get access to 100 shares for half the price. This is going to cost you $1,000 for 100 shares of Super Micro instead of $2,300 that you would be paying at market value. And again, you would need a break even, obviously, of 44%. It's a huge move to the upside you're looking for in this case here. But at the same time, Super Micro was trading around $30-something at the time before that news broke out. And, this is a year and a half to expiration. And the thing you're going to notice also, this one has a lot more of a higher implied volatility. And again, the higher your implied volatility is going to be, the more expensive your contracts are going to be as an option buyer. So that's also something to keep in mind about here. The good thing is you have a lot of open interest. You have a decent bid-ask spread here, which is very, very good as well. If you went even to the $20 one, that one's $1,100, and your break even is $31, which is basically back to where it was before the news broke out here. A nice 77 delta, decent open interest. Bid-ask spread is not too bad here. So that would be, again, literally about half of what you're paying. So instead of buying the $2,300 in shares worth, you can get it for half that price, $1,113, which again, not too bad. Break even obviously would be, strike price plus your premium that you pay. So $31.13 would be your break even. And if you want to be like somewhere in between, for example, I'm someone who has liked Uber. This is not financial advice, of course, so don't just take these trades as it is. I've liked Uber recently as a result. I know Uber had a big pullback, was trading almost as high as $100 in this case. Had a big pullback recently, but they are partnering with JOBY to do some transportation with VTOLs and stuff like that over out in the Middle East over there. So that's very cool. I took Ubers recently out of JFK. It's super expensive. People are paying hand over fist for it. It's absolutely wild. So again, Uber would be, 7,000. You want to buy 100 shares of this one here. It's going to cost you $7,000. You don't got $7,000? That's okay, fridge. Don't worry. Buy, call option, go way far out. And again, you can go further out if you want to. You can go all the way, you can go to January 2028 if you wanted to. It's still going to give you basically, again, that exposure to 100 shares without paying for that 100 shares worth. So, for example, if I want to go to the $60 one, a nice 76 delta here. Take a look at the open interest, 705, which is not too bad. Bid ask isn't too bad here as well. You open up this one right here, you're going to get exposure to 100 shares of Uber for only $2,435. And again, if it goes past $84, anything after that is pure profit. And you're basically having exposure to the 100 shares. Again, the delta for this one, you can read delta in two ways. Either it's how much it moves for $1 of Uber, or you can look at it as the probability of expiring with profit in the money in this case here. So a 76 delta means you're going to be expiring in the profit 76% of the time. It's not guaranteed. Obviously, these numbers fluctuate obviously a lot, as you will watch when you do more options trading. But that is how you look at leap options here. Again, leap options, you're looking at basically getting exposure and leveraging your portfolio. Because for me, I can say I have exposure to 100 shares of Uber for $2,400, and I can use the rest of the capital somewhere else if I want to, and then put that to work. And I still have the exposure instead of having to buy 100 shares at $7,000. So let's say that you are looking at a stock. Let's say you're going to NVIDIA, for example. Why? Because everybody knows the stock in NVIDIA. Everybody has computers, and it is down right now, as we'll see, down about 0.4%. Has actually been down for the year, down about almost 7%, as low as almost 13% here. And if you are somebody who likes the company NVIDIA and you want to get into NVIDIA, but you think, you know what, I want to get in at a little bit of a lower price. How you would do that is you will go over to trade NVIDIA options, just like we did yesterday with the Leap options video as well. And instead of being on the buy side and buying calls like we did from yesterday's video, today we're going to be on the sell side. And we're going to be doing what's called selling a cash secured put. Now, the reason that this is going to be beneficial is that you basically will get assigned to buy NVIDIA shares at a cheaper price. Now, if you remember from yesterday's video, remember options contracts, each contract is worth 100 shares, okay? And you need to have cash available to buy 100 shares of a stock at a certain price. So you're going to go to sell a put option here, basically saying like, I don't think, or I'm hoping that NVIDIA doesn't go below, the $150 strike price, for example, here. And if it does, then I will just buy the shares at $150 each. Okay, now these are obviously 0 DTEs. For the options trading, when it comes to cash secured puts, for me personally, I like to look at a couple things. If there's earnings coming up in a couple weeks, I might sell one for right before that one and maybe sell one right at earnings, because you allow a lot of IV expansion. But, the rule of thumb, usually people say when they're selling cash secured puts, go 30 to 60 days out. Usually May 15th, I believe, is the monthly here. So what you would do is you go to sell a cash secured put, and you'd be looking at, say, the, $150 strike price right here. Basically, what you are telling the person who is buying this contract is that I will buy 100 shares of NVIDIA at $150 each if it goes to that price. And what happens is that you collect this premium. Instead of being the one paying the premium up front, like we did on Leap options, since we are the option seller, we are actually going to be collecting this premium. $1.52 per share times your 100 shares gives you a profit or a credit, as you'll see up here, of $152. Now, the thing to keep in mind about when you're selling this option here, it'll say short put here, and it's going to be asking, it's going to make sure that you actually have to have enough cash in order to exercise this in case you get exercised. So if you were to get filled in this case here, what it will actually ask you to do is say you're not going to have enough cash to buy it. You need to have $15,000 in cash available. I only have $4,000, so it's not going to work out for me. So that's kind of the gist behind cash secured puts. I like to go about 30 to 60 days out, sweet spot, look at the monthlies because a lot more, obviously open interest, a lot more volume. You get a lot more liquidity there, which is very, very good for, positions getting in and out of trades, which is very, very nice as well. And then for deltas, for me personally, I like to go anywhere from like 20 to like 15-ish deltas here. I kind of shoot for, when I'm looking at my positions, I'm shooting for about 2% or more ROI in the monthly basis. Okay, because that annualizes to about 20% on the year, 24 to 30% on the year, which is going to be outperforming the S&P. It's kind of what my goal is. So if I was to sell a cash secure put, I would be doing one at the 160 here, maybe, and you might get a little bit. You're getting a little bit under a 2% ROI here. That's just again, you need to have the cash flow to do this for. Now, obviously, NVIDIA's implied volatility isn't super high, so you're not getting a very, very good premium as a result of it. But if you take a look at the ones I currently am running, as we will see here, for example, Super Microcomputers here. This is one example of one that I sold a cash secured put when it sold off quite heavily after all those allegations and the news break about the illegal smuggling and stuff like that. So I sold a cash secured put for $65, and it was a $15 cash secured put. So all I needed was $1,500 in collateral that I have here. And then I got paid out $65 to basically be assigned the shares if it goes to $15. Again, for me personally, I wouldn't mind owning Supermicro at $15. And as you'll see by the contract here, you'll see it's got a very, very high implied volatility. Very, very high implied volatility. Very low delta, which is very, very nice for us. We've already collected $20 or about 31% of that premium overall, which is very, very good. My usual take profits for these kind of trades here, if I get a big move up about 30, 40, 50% in like a week of that max premium, I'm already taking it off the table. I'm taking my profits. I'll give you an example of one I just closed out recently. I traded Carnival Cruise Lines. They sold off after earnings. Their IV went up a little bit as a result of it. And so what you'll see here is I sold a cash secured put here for $20. Or $20 put option here for $67 here. And in a matter of about 5 days, I made $31, almost 50%. This was supposed to go until May 15th. So been a little over a month away still. And I already collected almost 50% of my profits. So I took it and just closed it out and just called it a day. Because you know why? You already collected half of your premiums in literally, a week. And I still would have had over a month to go. There's no point. So I took those profits off there. So people that are asking about when I take profits here, I kind of look at about the 50% mark. If we hit over 50% profit in less than half of the time of the position, I'll take my profits off the table and I'll kind of call it from there. I'll give you one that I'm still sitting in right now. For example, RCAT, for example, I am still sitting in. I have until April 17th, so I got about 2 weeks left here, and I still haven't even taken 50% of my premiums collected yet. So I'm kind of just going to let this one sit for a little bit longer and just wait and see what happens for that one. That's kind of what I'm looking at for the RCAT one. Again, as you look at this one here, high implied volatility, very low delta here. I'm collecting $31 on, $1,100. So again, you're looking at almost a 3% ROI there, which again is a very, very good trade. For me, again, for a month-to-month basis, to go on about 3%, again, is a very good annualized return. Trade Desk, same thing. As you'll see, I'm currently in the money for Trade Desk, which I'm not really too happy with. So I'm not even close to being, profitable here. But even still, with us being, somewhat in the money for this trade here, the thing I do like about it is that you're owning Trade Desk at $22.50. And I got paid out to $82 on that one there. So my break even is $21.68. And that's where the CEO did some buying up of these shares here a little bit of time ago. So that was very, very nice to see overall for me. These are just a couple of trades I'm doing cash secured puts with. I'm kind of just letting them sit there and just doing whatever it's going to do, and hope for the best in this case. Iron is another one I have right now, as you will see. Sold a cash secured put here as well. I'm up 26% of the premiums I've collected so far, which is very, very nice. And as you will see with this one here, we have a high implied volatility, very low delta here as well. Buying iron at $20, which again, it's at 35 right now. So taking advantage of those high implied volatility days is very, very good for the portfolio. And again, this right here, $65 getting paid out on $2,000 in collateral. Basically means you'll be looking at, again, a little bit over 3% ROI, which I'm very, very happy with. But jumping back into the idea behind the cash secured puts here, what's really, really nice to know also, especially with Robinhood recently, they just announced this. I made a video about this earlier. The cash goes in as collateral, as you will see here. So whenever you sell a cash secured put, they take the amount you need to buy 100 shares and they put it aside in case you get exercised. So in case the person who has my contract wants to exercise this contract right now, I need to have the cash available to buy those 100 shares, which I do have it right here. And the nice thing about it that Robinhood recently introduced for gold members is that this cash is still collecting interest at 3.35% APY. So while it's sitting there waiting to be hopefully, either assigned or not, then we're able to, get some extra APY on that as a result, which I'm very, very happy with. What I want to kind of do is I want to show you guys a trade that I'll be looking at getting into for today's video here, and then we'll kind of just wrap it up and call it from there after that. Again, we're back up, 0.90. Amazing, amazing day so far in the market. For me, I'm very happy. What is SPY at before I do this trade here? I'm just curious. SPY is up 0.45, so we're actually doing very, very well right now, so I'm very, very happy to see that. So I'm going to do one with a super, super cheap option here because I don't want to break my bank here, for example. I'm looking to see if there's anything that's either down or has been down or ones that I kind of like as a value play for me long term in this case here. One of the ones that pops up for me is Zeta. I have a spreadsheet that tracks my numbers here. And Zeta, as you'll see, down about 22.5%, maybe found a bottom at about 14.55 here, which to me is very, very nice to see. So I'm looking at a bear case, probably anything under $13, it looks like here. So we're going to go into this. We're going to see. And what I like to also do here is I like to see when they have earnings coming up again. Their earnings are April 30th. So the end of this month. So for me personally, I would probably sell an option contract that goes right before April 30th because their earnings have a big move to the other side here. So we're going to take a look at a couple trades here. Again, they said April 30th. So maybe I'll go like April 24th, for example. And again, we're going to go to sell a cash secured put. And what I'm looking at right now, which I'm not looking at anything too crazy, these ones are tough because the bid-ask spreads are really, really wide. I wonder, I might have to go to May 1st and kind of hope for the best here. Let me see what we got going on here. The $13 one, yeah. So I mean, getting that 13 is probably not going to happen. $13.50 probably not going to happen. Again, the problem that we're going to face here is the bid-ask spreads and getting filled at certain prices. Like if you look at like a monthly, for example, it's not as bad because the bid-asks are pretty much close together, which is very nice. The problem that you're going to face obviously is that we have their earnings coming up, which could be a little bit of a problem. And I want to get filled at a decent price here. So I'm trying to just take a look and see the options chain here and see how wide that is. Like that's a wide bid ask you're looking at there. So maybe not Zeta Group for that reason. Because of that, I'm not a big fan of it. Let me take a look at my spreadsheet and see if there's anything else I kind of like. Sorry about this, guys. Take a look and see. I mean, I'm already in UiPath right now. Pinterest is one that still pops up on my spreadsheet. Pinterest has been undervalued for a long time, it seems like. I've been shouting this out multiple times here. When do they have their next earnings? May 7th. Okay, so May 7th is good. So we can maybe go to like May 1st, maybe do a cash secured put here. So again, about a little under 30 days here. But again, the reason why I'm not going past that to the May 8th day is because they have earnings coming up before that, which I don't want to have to deal with that. Usually what will happen with earnings is the implied volatility expands because the unknown is going to be, building and building and building. And when the unknown expands and when that, risk is there, the IV expands as well. So I just sell a put usually right before earnings because that way you can take advantage of, the IV crush. So in taking a look here, I don't even like Pinterest of these numbers here. Geez Louise. Come on, guys. What are we looking at here? I'm trying to see if there's anything else that I like. I'm looking back here at the spreadsheet. Let me take a look and see here if we got anything else. Hims, trade desk. We're already in trade desk. Super micro, I'm already in right now. I mean, I like Bath and Body Works. I just don't know if the premiums are there. They're down right now, which is crazy enough in this market. So what are we looking at? Earnings, May 20. I think he's already kind of sold one and bought one back. This would be an example of me showing you guys. Like, take a look here. This is me playing their earnings, right? I played their earnings here. I sold one for 40. I made over 50% ROI, 50% max premium collected on it in a matter of like a day. So not ROI. It was not 50%. May 28th. Oh, we got a point in time. Okay, good. May 28th. Great. Let's go to a monthly, for example, and let's see what we got for Bath and Body Works here. I actually don't mind this right here because what we're looking at is, let's take a look, is the bid ask is pretty good there, which is nice. We're looking at a 16 delta. $15 put option here, so buying it at 15. I have them valued about 14. Bearcat. Okay, I actually like this one right here, so I think we're gonna go in with this one right here. It's not a super aggressive play, as long as Bath and Body doesn't come down 16.5%, and if it does, I still get the maximum premiums. My break even if it comes down about 18%. So you're gonna go over here. You're gonna go to sell a cash card put here, just like so. I'm gonna try to see. The fan sucks. Obviously, is that like it goes in England's a 5. So you may get filled at this one here. So, and as we'll see, collateral goes in 15. You were agreeing to buy 100 shares of Bath and Body at 15 on or before May 15th. Again, if it doesn't go to $15, you can just the collateral goes back in your account, and then you keep the $38. For example, the $35 I get here, and we move on here. So that's really, really nice. And again, you don't have to wait till expiration. You can close these out whenever you want. It is not like you are forced to at a certain point. So we're going to get filled here probably at 35. It looks like. So maybe we got filled at 38. Let me go look and see. Let me go look because the $5 spreads are kind of annoying here. We got filled at, oh wow, we got filled at 39. Ooh, that's nice. That is nice. So what does that put us at in terms of profits here, or in terms of ROIs? So we got, and what I like to also do here for you guys, and I'll show you guys, is we're going to pull up the options profit calculator to kind of show you guys what we're looking at here. And then we'll wrap up today's video. This is a cash card put video example. So Bath and Body Works. I love this one just because it helps me to understand where we're at in terms of like what my ROI is and if this trade is really worth it for me. So we're going to hopefully pull the price here, which it does. You do a put option, you write it. We went to May 15th. We did a $15 one right here, and we got actually filled at 39, which is very, very nice. So taking a look here, look at the nice little calculation it does here. So some good numbers here, right? 24% annualized return, which again beats the S&P, which I like, 2.67%. Oh my God, 6.7, unbelievable. Break even 14.61. I have that as my bear case around that value for Bath and Body Works here. Probability of profit is 86%. 86% chance of probability of profit here. And again, if it comes down to that 17% mark, I'm buying the shares at a cheaper price. What this is basically telling me, and what I am telling the person who got this contract from, is that pay me $39 and I will buy your shares at $15. Oh no, I bought in cheaper. You're getting a discount. I'm getting a 15% sale on Bath and Body Works. I get paid for it as well. And if it doesn't go below 15, I just keep the $30 passive income. I don't do much on my side of it. We kind of just wait and see what happens over the market the next little while here. So that's very, very awesome to see for me. I'm very happy with this one. I got filled almost at that highest ask, which is very nice at the 39. And we're going to kind of just wait and see what happens. Basically, what the idea is behind it is you're going to be still selling options here, but instead of selling put options, you're going to be selling call options instead. Now, in order to do this, you would need to have 100 shares of a company. Now, for today's video, I'm going to be looking at my retirement account. I'm not going to do an actual example here because I don't like the market right now. Usually when the markets are down, you would like to sell cash secured puts because you get, a little more volatility for it. Premiums go a little bit higher up here. When you have green days is when you want to sell cover calls. So I'm going to show you guys a example in my retirement account here, as you will see, and then we'll kind of go from there. I'll do an actual example. I have a strategy that I think I'm going to actually want to work with, and you'll hopefully see the logic behind it as we go. So as you will see, I have a ETF here in my retirement account, SCHG. SCHG is the ETF, which is a Charles Schwab U.S. Large Cap Growth ETFs. And basically what it is you take a look at SCHD. You can see what the breakdown is. Again, a lot of it is in tech. You got NVIDIA, Apple, Microsoft, Amazon, you name it, the whole shebang. It's basically here in this portfolio. It is in this ETF breakdown here. And I've been buying up shares and then selling cover calls. I've actually been able to offload some of them, as you will see here. If you take a look down here at the bottom, you will see that I'm selling calls and buying calls as a result of it. If you look even further back into here, you will see that I did in fact sell a $29 call assignment here. I got assigned on it, which was again above my strike price at the moment in time, so I got some passive income for that as well. Then I used that money, bought up some more shares, so on and so forth. And I'll be doing the same thing in the future. Right now, obviously, I don't like where the market is. Usually, you want to sell cover calls on green days, not on red days. Cover calls, again, you want to sell when the portfolios are moving higher and the share price is moving higher, so that way you can hopefully capitalize on the upside here. So as you will see, we'll go to SCHG. And again, you need a 100 shares of a stock to do this as a cover call. As you'll see, I have 100 shares right here. You need 100 shares because if you remember from the first video about leap options and also the video yesterday about cash secured puts, you needed money to buy 100 shares. Options contracts trade in 100 shares per contract. So you're hopefully a little bit more familiar with this option, data up here with the buying and the selling, the calls and the puts. And again, instead of doing sell a put option like we did last time, where you be assigning and buying shares at cheaper prices and getting paid to do it, you're going to sell call options instead. And so if I wanted to go to, say, May 15th, for example, my strike or my share price right now, let me just double check here. I believe it's around $30 or so, if I'm not mistaken, $30.11. When you are selling cover calls, you want to sell a cover call above what your average cost is. Otherwise, you're locking in a loss if you get exercised, right? Which we don't want. We want to lock in a profit, not a loss in this case. So if I went to sell a call option here, and I did this one right here, the $29 one, even the $30 one, for example, that's about break even on my shares there. I would just get $55 in income as a result of it, but I'd be selling at 11 cents of a loss per share for the 100 shares. That's going to be, it adds up, so I would be looking at like a $31 one here, for example, here. $29, I'll obviously be getting filled at for a loss. So all you do is you go to sell call option here, and then boom, there you go. And then what I would be doing is I'll be collecting the $15 premium that you see down here, or whatever I get filled at. Maybe it'd be $20. I have no idea. I will get filled at the $20 price here, hopefully. And basically, if SCHD goes up to, I don't know if I can scroll down here. There we go. I need to move this down a little bit. So if SCHG goes up to $31 here, then I got to sell off my shares at $31. And again, that's not a problem. That means each share went up $1. My average cost is $30.11. Each share went up about almost $1. Times that by 100 shares is $100 there, plus the premium I collect as a result of it. Now, there is still a loss you can get here because as the share price goes higher and higher, you're still selling at $31, right? You're locking in saying, hey, I'm going to sell it to you at $31. If SCHG moons and it goes to like $33, $34, we get some announcement that comes out where Middle East conflict is resolved and all that kind of jazz. I'm still going to be forced to sell at $31, which I don't want to do. If it goes to $32, $33, I'm missing out on potential profits there, right? So you want to make sure you're picking a strike price that you are comfortable with, right? You're comfortable with getting rid of the shares at $31. For me, I'm not. I'd rather hold it for a little bit longer and maybe go up to like 32-ish, but there's no, obviously, like liquidity right now for this ETF, so I wouldn't be able to get assigned on it. And again, looking at deltas, might go like a 20 delta, 25 delta, depending on what you're looking at for your risk to reward ratio here. And again, it's kind of similar to, if you're talking about taking profits here, it's similar to how I look at cash secured puts. If I see that I'm able to collect 50% of my premium total in less than half the amount of the time left, I'm going to close that position out and then readjust and go from there, right? And what this does is it hedges your portfolio in a way. Because if SCHG, if the market continues to go down here, I get to collect more of this premium here, and my shares will go down in price here. But I'll get a little bit of some money here as a result, waiting for it to rebound, hopefully. So it kind of hedges your downside a tiny bit. Not a lot, but a little bit. Obviously, 100 shares at $29, you just $2,900. So if it goes down a lot more than that, you'd be losing some good money here. But you do get a little bit of a... You're able to collect a little bit of some money and use that. I can use that $15 to then buy up another half share if I want to. And again, imagine doing this with like thousands of shares. You could use it to collect more and more money. If you have watched me give this as, not financial advice, but as what I would do when we do Wall Street bet videos, all those videos there, it's always more of like people like YOLOing in, buying like thousands of shares. I always say sell some cover calls against it. Sell above your break-even price. That way you're able to collect some good money here. And as a result of it, you collect some good money. You're then able to hedge your position in case the market goes against you. So it kind of helps out. So for example, as you'll see here, the $31 put call option here has already lost, $5 today because markets are down. So it's already down $5 here. So I would have collected an extra $5 if I had it yesterday. So again, as the market goes down, the cover calls become worth less. And again, the cover calls become worth less because I'm farther away from that strike price. The farther away you go from that strike price, the lower probability is of being assigned. The lower the probability, the less it's going to be worth. Less it's going to be worth, the more money I get to keep as a result. So that's the cover calls. And again, you need 100 shares. You cannot just sell an option like this without having the shares for it. That's called naked selling, and that is a very, very risky strategy because, you never know what this market could do, and if you don't have the money for it, it could be a huge problem for you. So that's kind of the idea as to how cover calls work. Again, you're selling a call option in hopes of getting assigned at a higher strike price than what your average cost is. And then you're able to use that to be able to collect some passive income, use that money, put it somewhere else, whatever the case may be for it. Now, in today's video here, my example, I don't really like a lot of my positions right now. I mean, the markets are a little bit all over the place. I'm down 0.91% on the day. I don't know what SPY is down. Let me take a look and see if SPY is doing worse than me. I was able to kind of see what the markets are doing. Yeah, SPY's down 1%. So the markets are having some big reaction right now, obviously because of the, today's the deadline, right, for between Iran and the U.S. right now, according to the Trump administration, all this crazy jazz. I don't know. I can't keep up with all this kind of stuff, honestly. It's just crazy to me. So what I want to do here is I want to kind of weave in, and you guys get a little bit of an early glimpse here of the ignition index with the pockets to profit that we're looking at here. So the one I want to look at doing it for is going to be Wrecker Systems. Okay, now why Wrecker Systems? Well, it's down obviously 5.83%. We're down 46% right now overall in our ignition index for our pockets to profit series here. And it is down, 5%. So, and they just had earnings that were pretty good. They want to talk about reducing their costs for research and development. They want to increase their margins. They're moving, manufacturing back to the U.S. to hopefully, decrease, that their costs for manufacturing and stuff like that. Like their earnings call was pretty good overall. I read through the manuscript. That's pretty good overall here. Again, this is a very speculative play, though, of course, as you may know. So because it obviously is a market cap of $107 million. So I get it. It's a very risky trade you're looking at doing here. So what I want to do is I want to buy up 100 shares right now of Wrecker at about 79 cents. This is actually going to work out very nicely because the 100 shares I'm going to buy is going to reduce my cost basis down there, which is going to be very, very nice. And then I'm going to sell a cover call right away. Because these 100 shares I'm buying at 80 cents, I'm then going to sell a covered call in hopes that, if it goes from 80 cents to $1, that's 20 cents per share. That's a very, very good profit, plus the premium I collect there overall. So we're going to kind of do a twofold thing here. We're going to buy up into Wrecker, and then we're going to sell a covered call against it to offset the cost basis a little bit here. So what we're going to do is we are going to buy 100 shares exactly here, and it's going to cost me $78, which is, obviously nothing. And then what you're going to see here, so we're going to hit review order. I don't have that much money, obviously, to do it, so we're going to buy up. And I want to see this cost basis here go down from $1.48. We're going to buy up And there we go. It went down from $1.48 to $1.23. So that's really nice. We've reduced our cost basis there. And now, again, remember, that costed me $78, right? $78.80. What I'm going to do is I'm going to go to trade record options, and then I'm going to go till May 15th. They just had their earnings. I'm going to sell a call option here for $8. And I'm going to sell it here at the dollar strike price here. I could also go super risky and sell a 50-cent one and just, offset my shares already. I would lose $30 there on the shares and make 40, so I make $10 back, I guess, if I really wanted to cover it that way. But I'm going to sell a $8 call option here. So those 100 shares bought for $78. I'm now going to sell a call option against it. That's going to reduce my cost basis now from 78 down to $70 or so. And if it goes to $1, great. I sell out those 100 shares at a nice profit of about 25% or so. So we'll hit boom. We'll go here, and then I don't know what I'm going to get filled at here. I hope I don't get filled at 5. I really hope I don't, because it just sucks because, this won't get filled, I'm going to guess. Yeah. So I'm going to hope that we get filled at this one right here. Yeah, that one, the bid ask is way too wide there. I just wanted to double check. So maybe we'll cut that $5 or so, but I'm really hoping that we just get. So again, this is what it looks like when you're opening a contract here. So you are agreeing to sell 100 shares of record at $1 on or before May 15th. Again, about 30 days out here. So if you aren't asked to sell, then you will keep that and collect the full $5. Woo! But if you think about the math, let me get my phone out really quick here. $5 if I collected out of the 78 is a 6% return. 6% ROI in about 30 days. I mean, it's not awful. So let's take a look and see. I hope we get filled at we got filled at $6. Okay, so not bad. We got filled at $6 or so. So we got $78.80. We can do the quick math here for you guys here. So $78.80 minus the $6 puts us at $72.80 here. And again, $6 out of $78.80 will give me an ROI of about 8%. And again, if a record goes to $1, then those 100 shares I just bought for 79 cents get exercised, and we make 20 cents per share there. So $20 there, plus the $6 share, $26 potential ROI here. Out of 78, that's really, really good returns. Obviously, I have no idea. And what you'll see over there is that it went into collateral. So you have 100 shares now. So now it's not cash collateral, it's shares collateral. So keep that in mind. That is a difference. You don't collect interest like you may have on selling cash secured puts here. But if you take a look, here's the position here. Again, and the bid ask spread, it kind of sucks, obviously, so I completely understand it. But, so here's our nice little option chain that we're looking at here. Again, about a delta, about 40. And again, it's a very low risk trade. I paid $78 for it. I got paid $6 back. And then if record goes to $1, great. Even if it goes above that 79-cent mark, I'm still profitable overall in the trade, which I'm very, very happy with. So that is the breakdown of how you can look at doing a cover call. This is a very, obviously, cheap example. Just kind of give you the visual as to what it looks like on the Robinhood account here. Again, you can do this with a lot of stocks that you're looking at doing. My hope and my goal would be to, again, you might have heard me talk about this before. My hope and my goal is to take these positions here, all these ones. This is my pockets to profit ignition index over here. I want to eventually get these all up to over 100 shares so I could sell some cover calls against it, get some passive income to offload it. My first big target is going to be Big Bear AI, then probably Rich Tech Robotics, and then we'll start building up the other ones as well, hopefully, and be able to make some good money there. So thank you guys so much for watching today's video. That is how cover calls work when you're selling a cover call in your portfolio. Again, I get $6 paid passive income here for $78 I just spent, which is, a nice almost 8% ROI potential plus the appreciation of the shares maybe. Is that a risky trade? Of course it is, because it's a very, very low cap stock. It's a very small cap one. But you can do this with NVIDIA, Google, Netflix, Amazon, you name the company, and you could definitely do this with it, So that's something to keep in mind about. And again, if you are already up on your shares, collecting some passive income now isn't bad. And again, it kind of hedges your portfolio a little bit by selling a cover call here. How the wheel strategy really works is it involves selling options. And again, when you're an option seller, you are the one who is collecting the passive income as you wait for a stock to move in your direction. For example, yesterday's video was about how to sell a covered call, collect passive income as you wait for the stock to appreciate in value. And then the day before that, we took a what's called a cash secured put position. We sold a put option, and that put option was on Bath & Body Works, as you'll see up here. So basically, the wheel strategy, what it is we're going to be taking both those ideas, the selling cash secured puts, the selling cover calls, and creating the overall wheel strategy. Okay, so for example here, as you will see, first of all, market pumping, which is very, very nice. I'm happy to see it right now. I closed a couple positions out this morning here and took about like 40-ish% of the max premiums on some cash secured puts. You might see already that the ones I closed out this morning that were here yesterday were iron and also super micro computers. We closed both those out this morning for some good profits. Again, this pump, I don't know how long it's going to last for, so that's why I just saw the opportunity to take some money off the table and then use some of that money now back into my buying power to then open up a new position, hopefully today, after the market closes. So as you will see here, so this Bath & Body Works put option here is actually losing some value, which we're very happy with. Again, selling a cash secured put, as a little bit of a recap from the video from Monday. When you are selling a cash secured put, the goal is to collect passive income, get paid out while you wait for a stock to reach your buy price. So for me, I like Bath & Body Works at $15 per share. So I sold a $15 put option. Basically, I am telling somebody, hey, I will buy your $15 share price of Bath & Body Works. I'm going to buy 100 shares at $15 each. That's going to cost me $1,500 for this position to open up. And that cash goes in as collateral on the side as we wait to see what happens. Now, for me agreeing to buy these shares at this price, I get paid out a credit, or what we call a premium in the selling options, space here. Okay, so I was actually paid $39, as you will see there. It's 39 cents per share times 100 shares gives me $39. I was paid out $39 to have the chance to buy Bath & Body Works at $15. And as you will see, since Bath & Body Works has had a big move up 4% this morning so far, it has become less likely for that to happen, which means the option loses value, and we are now up $6 already, up about 15% of the max premium that we're looking at right now, which is very, very nice for the first couple days here. And this is going to go all the way out until May 15th. So until May 15th, we shall wait and see. And so, again, I collect that premium there. It goes into my account. And, again, if I wanted to close it, I would be able to buy it back if I want to. If you ever want to buy back your positions, you definitely can do so. And so you can look at the delta here. Here's me selling the put option on April 6th. I got $39 for it, about 24% annualized return if this was to happen over and over again, which I'm very happy with. Again, that would beat the historic S&P 500 return here. So very, very happy to see this as a result. It just dropped a little bit more, it looks like. Oh, great. Well, it's also because the bid-ask spread's a little bit different. But, we're up at $11 now, which is absolutely amazing. Not too shabby about that so far. So basically, that's what selling cash secured puts does, okay? It allows you to potentially enter into positions at cheaper prices. Now, the nice thing that you will see here that Robinhood recently announced that I made a video about as well is that as that cash is getting put to the side, it is still earning interest, which I'm very happy with, because that way I'm allowed to still collect some interest on my money that's being put aside, because again, it's not being spent. This $1,500 did not get spent. It only gets spent when I buy the actual shares, but until I buy the actual shares, it's not being spent, and it's still going to earn that 3.35% APY as a Robinhood Gold member. So now you're saying, okay, so again, we keep selling these options. We sell puts, we sell puts, we sell puts over and over and over and over again. We're going to keep selling them. We're going to keep selling these puts. And then at some point, we will get assigned. Oh my God, for $14. Woo, look at that. You would have paid for yourself right there. You would have paid yourself a little over a month, about 2 months of the Fridge Financials premium membership right there from $14 on $1,500 you needed. How amazing is that so far? So as we're taking a look at these trades here, okay, so let's say we now get assigned the shares, okay, and I'll give you an example of one that I'm probably going to be assigned at, if I was to guess. I'm going to be probably assigned at this trade desk position here. which is crazy that the market is pumped up already over 1%, almost 1.5%, and Trade Desk has just gotten rug pulled out from underneath. That's absolutely wild. I can't believe that. But, Trade Desk announced news recently. They're laying off people. People are stepping away. Just crazy, stuff for this company here. But I still like the valuation for it. So I'll probably let this one get assigned and just kind of just see what happens here. But so what's probably going to happen is that I will be assigned this put option here. Now, first of all, I'm going to take a little bit of a loss, depending on when I get assigned on this position here, because, again, I'm going to be buying the shares at $22.50. So if you look at this position here, I'll be buying the shares at $22.50, and right now it's at about $20.70. Take away the premiums that we collected from it, as you'll see down here. Take away the $82 we got here. My break even is still $21 a share, 21.68, and we are still below that. So we're currently down on this position. But again, it allows me to enter in at cheaper prices, right? So I'd be able to get in now. And again, if I really want to, I could roll this position out further, which I may think about doing. I'm not really quite sure just yet. But so then let's say that, you get assigned the 100 shares. I got $22.50 per share for Trade Desk, 100 shares worth. Now I have 100 shares of Trade Desk. What do we do? So the first half of the wheel strategy is to sell cash secured puts over and over and over again until you get assigned, which again, I'm probably going to get assigned here if I was to guess. We'll wait and see what happens. We still have a little over a week away, so we'll see what that happens with Trade Desk here. I'm not going to get too crazy with it just yet in terms of like jumping the gun onto what to do, because I still like the price that Trade Desk is at right now. So I might just hit the assignment. If I wanted to sell another one later on, maybe for cheaper, I definitely could. But so then let's say I get assigned the $20.50, price of Trade Desk for 100 shares. Half the wheel is doing that. The second half of the wheel now is to now sell cover calls on the other side. Because remember, you need 100 shares of a stock to then sell a cover call. Well, I just bought 100 shares of Trade Desk at this price here. So now what I'm going to do is I would go out and I would say, okay, I'm going to sell now a cover call. So you go to the view options chain here. You would go to sell a call option here. And again, this contract, the put I have right now, won't expire till next week. And I'll get assigned at like $22.50 probably, depending on what it might be. So I might go to May 15th, which might be another month out or so. And then let's say that now I'm going to now sell a $25 call option, for example. Now, what's nice about this is that now I'm selling this $25 call option. Now, the other side of what will be happening here is that I'm telling somebody you can buy my shares of Trade Desk at $25 a share. Okay, and I'll get paid out, for example, $95 here if I was to do this today. I don't have the shares yet, so I can't quite do it. But so what does that mean? That means that if my $22.50 price that I bought for Trade Desk, if it goes up to $25 and it appreciates in value, I then sell my shares off at a profit and I get the premium as well. So what is that going to look like? So if I got in at $22.50, I would make $250 on the appreciation of Trade Desk here. And I will get the $95 in premium here as well. So adding those two together, I mean, you're looking at, over, what is it, $250. You're looking at $345 of money I just made. And then I got in and out of Trade Desk, no problem. I got in at $22.50. I sold out at $25. I made, some good money, made about $300 and something if this was the trade that would go through. Now, this delta isn't too bad. Again, a 30 delta means that it's a chance of happening, but not super likely, of course. And again, the IV is pretty high as well, which we like. And the open interest and volume looks pretty good here as well. The bid ask would look pretty good here. So if I got a sign next week, I'd be looking at a $25 probably strike price to sell off my shares at as a result. Now, when you're selling a cover call, obviously, the downside is that if it goes past that one, you obviously lose out on potential profits here. You still make money, but the expected loss is because technically you're not getting all of the gains in that case there. If it goes to, $28, you sold at $25, you lost money. I really didn't, but that's kind of like the logic behind it, right? And so that's how the wheel strategy works. So then what would happen is that I would sell all my shares off, right, at $25 each at this little strike price over here. And then that would free up cash to then sell puts again. Sell puts, sell puts, sell puts, sell puts. Get assigned, sell calls. Get assigned, do it again, and do it again, and we do it again. This is the wheel strategy in and of itself. This is basically what it does. You sell puts, you get assigned, then you sell calls, you get assigned. You sell puts, and you just keep doing it over and over and over again. The thing to remember with this strategy here is you got to be willing to do it on companies that you don't mind owning shares with. If you're doing it just to make a quick buck, that's where a lot of the psychological factors come into play, and people have some problems, with knowing what to do, how to open up a trade, all that kind of stuff there. So that's something to kind of keep in mind about. Again, like I'm down $126. Oh my God. I mean, again, for me, I don't mind owning Trade Desk at $22.50. For me, I don't mind owning Bath and Body at $15. I'm probably not at the rate it's going right now, which is really happy. I don't mind owning RCAT at $11, but I did put a limit order in to get it off just because, it's a very volatile play here. UiPath, I don't mind owning at $11 here. This one I may also be assigned at in terms of a position here. It's at $10.95. I want to get in at $11 here. Now my break even is actually $10.63. And again, once I get assigned, if I get assigned on this position here, I would then just go to options. And then I would go to, the May 15th one here. And then I would just say, again, I'm getting assigned at $11. I could just sell a $12 one or a $13 one. When you're selling cover calls, do not forget also to sell at a higher strike than what your break even is. If I got assigned at $11, it wouldn't make sense to sell one at $10. Unless I'm being very, very bearish in the stock, in the market overall. But even still, I wouldn't do that. That's something to keep in mind about. If I really wanted to, I could sell one right at that break-even price and just get a maximum premium just to really kind of make sure I collect the extra passive income there. But I'd probably sell like a $12 one maybe. That's a nice delta of 34, maybe a $13 one for less, less probability in this case here. There's all these different things you can look at doing in this case, but the goal is to collect passive income. And again, doing it on shares you want to own. And that's the big thing that we want you to take away from on the wheel strategy. Now, with that being said, the company that I'm now looking at going into right now for a potential wheel is going to be Applied Digital. Now, Applied Digital does have their earnings come up after hours, and I do actually have shares of them, very, very small amount here, as you'll see here. This is part of the Ignition Index that I have here. This cash secured put that I want to get into maybe is one that has nothing to do with the Ignition Index. I'm not going to price that in or anything. This is me trading the stock as to what I want to trade it to be at. That's obviously just my 2 cents for it. But they have their earnings come up after hours today. They've been doing pretty okay on their earnings recently. They are expected to still be negative in terms of profits, which, as a profitable company, which again, it is what it is for this one here. But, when you have earnings come up here, the options premiums are very much juiced up. And what I'm going to do is I'm going to pull up the options profit calculator here and kind of just show you guys an example as to what I'm going to be looking at doing to start the first half of the wheel strategy. So I'm not going to open the trade right now because market just opened. I might wait till right before earnings, right before the market closes for earnings, because IV is going to expand between now and 4 o'clock. So I want to kind of take advantage of that in that case there. But if you go to trade Applied Digital options here, again, if you wanted to sell a put that expires in 2 days, the IVs here are going to be super, super juiced. 200% IV on this contract here. I don't like to do that. That's a very, very short-term swing for it. I would be doing more of like May 15th, give about 30 days out. It's a monthly contract, which is very, very good. A lot more liquidity there. But even taking a look at some of these here, you're looking at 37 days out here. And I'll tell you the one that's really got my eye right now is this $18 one right here. $18 Applied Digital, which again, I just closed some positions out to hopefully open this one up here. A 9 delta pays out $55. So if you take a look at the options profit calculator that we have here, I'll go into new cash secured put here, go to APLD. And again, this is not financial advice, of course. May 15th, go to the $18 one here. Again, a delta of 9 means that's very, very likely to happen. Obviously, the IV is huge because of earnings. And as you will see here, it still gives me a 30% annualized return, a over 3% return on my money here, a 91% probability of profit here. And Applied Digital would have to sell off 34% for me to even be like at that strike price. break even, I'm looking at still about 35-ish% on the downside here. And this is a company where, again, with their earnings being built in here, it could have a big move in either direction here. But I like this because what will happen in these two cases. Applied Digital has great earnings, which is awesome. And then this option becomes worth a lot less very, very quick. It shoots right up after hours. This option loses money. We close it out pretty quick. We call it a day. Second option, it comes down a lot, but I have money from my ignition index to unload into APLD here. And again, if I get assigned at $18 a share, I'm pretty happy with that. Then I can then start the covered call process and go into the wheel strategy from there. So that's a trade I'm looking at getting into most likely before market closes today. I'm going to kind of watch to see how Applied Digital and how the market reacts because we had such a big move at the beginning of the market open here. Is Applied Digital going to hold this, this percent return for the day? Or are we going to get a bigger pullback into market close? Are people going to take profits? Because again, for me, for example, I took profits on a couple of my trades that were cash secured puts. Super microcomputers, I made $30, basically about 2% ROI in a matter of like a week and a half, which I'm really happy with, honestly, as you'll see there. And the other one I closed out just a little while ago after that was also Iron. Iron was about a 1.5% ROI in about 2 weeks as well. So again, nothing too bad about taking profits, guys, especially in a market like this. Myself and Ryan, we did a podcast on Monday about this. And last year he was talking about how when we had the big bull move last year a lot, where it was like just a lot of toggling and all that kind of stuff like that, and markets kept pushing higher, he sat there and he said that when I had a bearish position, if I made money, I was out of it quick on a bearish one because I knew the market was going to rebound at some point. This is kind of how I'm taking this year's market, where I feel like there's a lot of bearish, things that are happening, in the bigger picture here. So if I have a bullish position like a cash secured put and I can close it out and make some money and then just like peace out and wait again, like that's what I'm comfortable doing. That's what I'm going to be doing here. So that's just something to kind of take away from this case. As you see, we have some cash ready to go. So we'll hopefully be waiting for that one as well. And here's my record position as well. Record doing pretty nice, actually. I bought in at 78 cents yesterday, those 100 shares, and we were up $3 on those ones, which is absolutely amazing. So I'm very happy to see that. So that is it for today's video. That is the wheel strategy. Again, quick recap. You sell cash secured puts over and over and over again. Wait till you get assigned on a company you like. Make sure it's a company you like. And then once you get assigned those shares, you then start selling cover calls and at prices you want to, you'd be okay with selling it at. Obviously, don't sell for a loss. You want to sell for big gains and profits there. So and it's just a passive income cycle over and over and over again. You make some good money on it, and that is the goal of the wheel strategy.
We have now gone into a little bit more of an advanced strategy here. So what I'm going to do is I'll give you guys a little bit of a quick recap of what we covered so far in this week here, and I'm going to talk about the new trading strategy that you have available to you if you are looking at doing it, and it is the poor man's covered call. Now, the poor man's covered call is a strategy that you are able to do on a leap option if you don't have 100 shares of the stock. So if you take a look at the Fridge Financials channel right over here, whoosh, there we go. Also, shout out to everybody here who's supporting it. We're over 1,500 subscribers. We're very close to getting the 4,000 hour watch time. So if you're watching this and you want to help contribute, feel free to do it either by watching the videos here if you want to. Feel free, of course. But if you take a look at all the videos, look at all the content we've been putting out here recently. We did the wheel strategy about selling call options and selling put options here for passive income. We did a cover call video specifically. We did a cash secured put, and we did a leap option as well. Today's video is going to be kind of combining the idea of the leap option we have here along with the cover call. And that is what creates what's called a poor man's version of a cover call. So if you're looking at a position like NVIDIA, and again, I'm going to do an example. I have a stock that I have in mind that I want to do this with that won't be super expensive for me at least. So I'm willing to take it and go with it from here. But say you have a stock like NVIDIA, the biggest market cap company in the world. Everybody knows NVIDIA. Everybody loves NVIDIA. And you are bullish on NVIDIA for the next year out or so. Again, a leap option, a little bit of a recap as to how leaps work. Leap options, what they do is they give you basically access to 100 shares of the stock without having to buy actually 100 shares. So for example, if I wanted to buy 100 shares right now, it would cost me over $18,000 cash right now, which I don't really have that. I know I might see that in the buying power there, but that's with margin, and I don't want to get involved in all that kind of stuff, especially with the riskiness we're dealing with in the market right right now, having margin probably isn't the best thing right now. So instead, what you want to do is you want to go maybe, leap options. I want to go at least a year out. Maybe you want to go even further out to June of 2027, for example, here. And you want to basically buy a call option that you might see right here. And for a leap option, I like to buy one where you are in the money. Basically, it's at 183. I want to buy a leap option with a strike price that is below the actual share price right now. And I look for a delta of around like 0.75 or so. The reason why I do 0.75 is that means that for every dollar that NVIDIA moves, this options contract is going to move up by 75 cents for the contract, which is very nice. So what you would do is you go to buy a call option here. It might sit there and say, well, Fridge, I don't have the $5,275 here. Keep in mind, you're getting access to NVIDIA for 100 shares worth, basically, for a limited time, obviously, for over a year. And instead of paying 18 grand, you're paying 5. So Leap Option already by itself is doing very much an awesome job because it makes your cost basis a lot less. So you want to buy that. Now, again, what you'll see here is that NVIDIA will basically be break even at 207. We went over how the break even is calculated here. So, take a look at that. Basically, if NVIDIA goes up 13% between now and June of next year, you'll be making some very good money without having to put up $18,000 in cash, which again is very, very nice. We put up $5,000 here. Now, people might say, well, Fridge, I don't have the $5,000 here. Is there something that I could do in the meantime? Is there a way that I can make this a little bit cheaper? And today's video, tomorrow's video, talk about how to trade these stocks here with cheaper prices so that we're not going all in all at once. Now, let's say that, you think that NVIDIA is going to be bullish long-term, but maybe in the short term, you're like, I want to collect some passive income along the way. Remember, selling covered calls allows you to collect premium and get paid out while you wait for the stock to have a higher move, right? So let's say I want to go to May 15th, shorter term, about a month out here, and I'm thinking that NVIDIA, now I'm going to sell a call option here. I'm going to sell a shorter term call option. This one is my leap option, as you see right here. It cost me $5,000 here. And now I want to sell, say, the 195 for $308 here. And basically what this is going to do is you're going to get paid out $308 here, which will offset your cost basis, not by a lot, but by a little bit still in this case here. And so as long as NVIDIA doesn't go to 195, we collect the $308, and then we still have this leap option here available. This is called a poor man's cover call because people say, well, Fridge, aren't you naked selling a call option? And in a way, yes, but you also aren't because the leap option, if you remember, that leap option is equivalent to 100 shares as each contract is. So if NVIDIA goes to 195 up to here, for example, if it goes to 195 and they come knock on the door and saying, where's my 100 shares? We could just exercise this call option here and use that as the collateral instead, and you'll be able to cancel the trade and we're good to go. Now, the thing to keep in mind about with these kind of strategies here is that if it gets close to this 195 mark here, it goes to like 194, whatever the case may be. If it goes to like 194, 192, or whatever, if it has a big move up, I don't even wait for it to get close to it. I would just close it out once I get some very good profits here. If you look at the profit screen over here, I'll slide over a little bit here. Whoop. If you look at the profit screen right here, you have a chance. If it goes to 195, you make $1,074 on 4,900. So you're looking at almost a 20% ROI, about 20% ROI-ish return if NVIDIA goes up 6% between now and May 15th, which again is a very, very good return. And as you will see here, though, keep in mind, as NVIDIA's share price starts to obviously get higher past that 195, this sold call option is going to be worth more, so it's going to cost you more. But then the leap option also is going to go up in price as well. The idea behind this is that the leap option is going to appreciate faster, and it's going to allow you to collect more profits overall, okay? So even though it's like, oh no, Fridge is at $205, whatever the case is, that short call option is going to be taking away money from your profits, but that leap option is already going to be getting close to being in the money with over a year out. That's why that leap option is going to kind of offset the loss you get from the short option. You get made money from the long option there. So it's a very, very good strategy to have in this case here. Obviously, depending on what you pick, if NVIDIA goes obviously to like 62% up to about $300, I would be basically break even, which again is a very, very good break even I would have. And again, the good thing is if NVIDIA doesn't go to 195, this leap option may have lost some value, but not nearly as much. And you collected $308 to either put into a different trade, if you want to use that cash to go towards, averaging into your position, you definitely can. There's a lot of different ways you can play this out here, but you get passive income as you wait. And again, if Nvidia goes to 195, okay, close the whole thing out here. We call it a day. We make our profits. We're done. Set your profit targets at whatever it is you want. For me personally, if it gets anywhere close to that 195, I would probably be looking at closing the whole thing out. It obviously depends on your position size, your risk to reward ratios. It's up to you. But keep in mind, though, right? If you can make in 36 days, even 5-10% in a month, that's a phenomenal returns. 10% of this would be about $500. So if you can have this go to $500 here, even if it goes to 191, if I can make $500 profit, I might even take that out and just call it a day because it's really good money to make in terms of 1 month. Right? So that's how the poor man's cover call works. Your short call option that you're selling is having collateral from your leap option. Now, keep in mind, you cannot do this in a retirement account. I opened up stupidly. I didn't do the research a while ago. I have some leap options on Novo Nordisk, and I've been trying to sell call options, but I cannot in the Roth IRA account. You can do it in the individuals, but not the Roths. So keep that in mind if you're looking at doing this in your retirement account for that reason. So that's kind of, again, the idea behind how these poor man's cover calls really work. You can get passive income still without having to buy 100 shares in NVIDIA. Obviously, you have managed the position a little bit more here, but it's something to keep in mind that could be a very, very good trade for you overall. As you will see, the portfolio is, a little bit down about 0.5% today. Again, I'm actually really happy with that one. I did a little bit of risk management here, and I'll do a different video about that later on. We were down about 1%. Now we're kind of back up a little bit, which I'm very happy to see. And the trade I'm looking at doing here is going to be actually on Super Micro Computers. Okay. Super Micro has been a stock that I still find undervalued here. It's a big play in the tech space and data centers and stuff like that. And even though it's been down obviously a lot, I still think it's an undervalued play to look at in this case here. And it's a cheaper stock. So I'm not going to lose my mind over this position here. Okay, it's at $23 or so. As you will see, it is down quite a bit from the beginning of the year because of the illegal activities over in China and stuff like that. It still is a computer technology-based company that's going to be really good for AI and stuff like that. I don't see a problem with it. Down 21% year to date. Obviously, it was trading sideways about $30 or so, and then that came out. And it's hopefully starting to do a bit of a rebound here. So I'm kind of liking this position here. So I will go into trade SMCI options here. And I'm going to go far out. I'm going to go way far out here. I'm going to look at the price points to see here. So let's say, what if I wanted December of next year? And again, the longer your strike price is, the more short-term call options you could sell in the meantime to give yourself that extra passive income, which to me I think would be really, really nice. All right. So this trade right here, I can buy a $20 leap option here. I'm going to do it. Let's see what the open interest looks like here. The problem you're going to have with the leap options is obviously getting filled on your bid-ask spreads here, so keep that in mind. We may have to take a look at some other ones here. But this one's got a 77 delta, which is very, very good. It's in the money here, $20. My break even would be about $31 or so. And again, it was trading about $31 before all that news break came out and everything else. When you're doing these positions here, I have to do them separately instead of just do it all at once. So, for example, if I'm looking at this right here of a $20 call option, on SMCI, and I don't know when their earnings are. I should probably take a look. Hang on. I always have to play earnings on this one because earnings could be a huge move in either direction. So I always like to do the earnings play to kind of help out a little bit in this case. It just helps me just to visualize more about what's going on here. And my computer's been super laggy today, so extra watch time for you guys. Watch my loading screen. Let me see when the earnings are going to be because that definitely plays a huge part in the IV and stuff. Earnings are May 5th, so about a month out. Okay, so I'm going to keep that in mind here as I'm trading this here. So we're going to go back to, I'm going to go to December. I don't know why I highlighted all that. And we're going to take a look here and see what we can get filled or assigned at in this case. What's the bid ask here? That one's I'm trying to see if there's a good bid ask to look at here. I mean, these are all a little bit all over the place here. So I'm going to buy this option here. It's going to cost me about $1,100. I'm looking for a 34% move to the upside. And again, it's basically back to where it was at. And again, I'm looking at to almost 2 years. A little over, a year and a half, basically we're looking at here for this stock to go up that much percent, which again is the end of 2027. So now I want to do a shorter term option here. And again, May 5th was what they were looking at here. So I'm going to sell a shorter term option here, for example. And then we're going to look at the profit. And again, the IV we're looking for is very, very nice here as well. So let's see if I do a 26 here. like a $26 call option here. Take a look. Let's take a look at the profit target here. So this is going to cost about $1,000 or so, $1,053 here. And if it hits $26 before earnings, I would have made $271. Again, about 20-ish% ROI here in a matter of 22 days. The reason why I'm doing right before earnings is that because that way this will be closed out before earnings. And what that's going to allow me to then have is that if it closes out and expires worthless, I can then sell a higher cover call with higher IV with it right before earnings comes out here and make some really good money there as well. Let me take a look at the 25 here. 25 here puts me at about 1026, so $1,026 or so, and I have $6,000 available here. And that would put me at, about a 20% profit here in this case. A little bit more of an aggressive trade you're looking at right here. What's the bid ask looking like? 110, 118. This one's a tighter bid ask spread. It's a little bit more risky, but what you'll see here is I'm already offsetting my cost basis about 10% in about 22 days. And again, if it goes to $25, oh God, I made $220 in a matter of 20 days. I made 20% in a matter of 20 days. Like, that's really, really good return, obviously. And obviously I'll start to lose money if it goes up like super high. So I'm actually kind of happy with this trade here. So what I'm going to do is I'm going to try to get in on this long call first. And I'm going to show you guys how this works here. I like to do two separate ones because it's easier just to roll positions out individually than have to close things out back and forth. I'll do a video about rolling a little bit later on here. Let me see if we can get filled at 1140. Review order. And let's see. You're paying. Okay, yep. Let's see if I get filled here. Might have to wait and see on that one there. And then what I'll be doing is I'll be selling the cover call here at 25. So I'm not going to sit here and just wait for it to get filled. I want to make sure I get filled at a good price here. So I'm not going to sit here on this camera the entire time doing this. I'll probably post about an update on this one in tomorrow's video to show you where I got filled at for the cover call portion and everything else. So make sure you come back tomorrow to see the actual position that was opened here. So that's how it would look though. Again, I would then sell this cover call here. And that way I will collect $115, which would be very, very nice passive income. And then I'll use that to either offset my cost basis for some other positions. Or what I could also do is, save up that money, build it up to then if I want to buy another contract here, I definitely can. So if you are looking at a ticker like SPY, which is the S&P 500, it is currently trading at almost $680 right now at the time of recording this. And the thing that you want to look at here is, if you want to buy 100 shares of SPY, that's going to cost you $68,000, which a lot of us, myself included, don't have that kind of buying power. If you want to go into the options chain and you say, Fridge, I want to buy a leap option. I want to go far out here into next year. We did a video about leaps the other day. We did a poor man's cover call as well with that one. If you were looking at those saying, Fridge, I want to go out to say June of next year and I want to buy an option like, that's in the money in this case. Again, I know you talk about how it's going to be 75 delta. You're looking at $10,000. Fridge, I don't have $10,000. I can't do leap options. I can't buy longer-term dated expirations because it's just so expensive because the price point obviously is $680. Let me show you an advanced strategy that you can do that you can take advantage of SPY moving in a direction that you are wanting it to do without it costing as much. And we're going to do it in two different ways here, where if you're someone who likes to be the option seller, we have one way of doing it. If you like to be the option buyer, we do the other way of doing it. So we're going to cover both methods here in this case. We're going to show you guys doing it with SPY. We'll show you how you can do it with NVIDIA. You can do it with Google, Amazon, you name it. And what you are going to be trading is called spreads. Now, when you are trading stocks and you're trading options in particular, when you build these strategies here, there's a debit spread and there's a credit spread. Now, a credit spread is on the option selling side of things here. So, for example, if you're looking at SPY and saying, Fridge, I don't think SPY is going to go super low between now and next year. Obviously, SPY usually goes up about 10% per year. That's the historical return. I'm thinking that SPY will not go super low in this case. And I'm going to pick one that's got a very, very far out delta, for example, here. Maybe it's like, I don't think it's going to go below $600, for example, here. So you're going to go to sell a put option here, and you're going to sell the $600 one. Now, if you were to just do a cash secured put, this would cost you $60,000 in collateral to be put on the side while you wait for SPY to do what it wants to do. But again, a lot of us don't have that kind of cash just lying around here. But if you still think that SPY won't go to 600, let me show you guys what is called the credit spread. What this is going to happen here as a result is that instead of just saying that you have a cash secured put here or a naked put, which is even worse, instead of just having a cash secured put here, you can have another way in which you can trade this strategy here. What you will do, or what you can do, is you can go to buy a put option here. And again, when you're buying contracts, they count as 100 shares worth, essentially in this case. So you're going to buy the $595 put option below underneath. And what's going to happen, what you're going to see is that these numbers are going to change. Oh, I'm in the way. Whoop. Yeah, let me just slide over to here. Okay, looking at these numbers over there. Now I'm all over the place. Look at the numbers over here on the right-hand side here. As you'll see, max loss is a lot. If SPY goes to zero, max profit is $2,500 here. But the thing is that you want to be able to open this trade here without having $60,000 in collateral to be put up. You don't have the availability to do so. So what you will do is you will buy a put option instead. And what you're going to see is going to happen here. It creates what's called a put credit spread. So this put credit spread that you see right here, basically saying that as long as SPY doesn't go to $600, great. And if it goes to if it goes anything below $600, then we're going to be in a little bit of trouble here. But what you'll notice is that it actually creates a much smaller max loss, and it obviously limits your max profits, as you will see here. And so basically what's happening is that the width of the spread here is $5. So it's going to cost, essentially the max loss is $500 in this spread here. But you get paid out $99 for this trade to be open in this case here. And so that's why your max loss is $401. So that's kind of something that's very, very interesting to look at here. And this is what's called a put credit spread. Now, this one would cost you $500, but it still helps you capitalize on making sure that SPY doesn't go down to the downside here. And, this is just an example. This is not a trade that I would be doing personally. This is just an example as to what you could do to kind of, collect passive income on the side while not selling cash secured puts on big names like SPY, the Qs, NVIDIA, Amazon, Google, all that kind of stuff there. So this would be an example of a far dated one, for example. I was just on a leap option for this case here. But let's take a look at one that's more of a shorter term one, okay? Let's say that you want to go to May 15th, which is a monthly, so you got a lot more liquidity there. And you want to say, I'm going to bet that SPY won't go below, I don't know, like a 25 delta maybe. Why not? We'll go 655. You're saying that, Fridge, I think that SPY won't go to 655, down about 3.5%, as you'll see over there, between now and next month, so May 15th. But again, when you're selling this put option here, it's going to cost you, in cash collateral, $65,000 in case you get assigned. You got to buy the shares. So you're shorting it right now. So what you do is you go to buy, and this is where I say that it can cost you as little as maybe about $100 here. If you buy the leg right below instead, what you will notice is that your actual max loss is going to be $83. It is $100 because of the $1 difference in the strike prices here, but you get paid out $17 as, a premium up front. And basically you buying this contract here, you're getting paid this much, but you're buying this one here, so you get the difference in it is going to be your credits. So you get a credit in the spread here, which is what creates what's called the credit spread. And again, your max loss would be, $100 here minus the premium you get. So it'd be $83 as a max loss. So you can trade SPY put options with only as little as $100. Now, this is an advanced strategy, and there are some risks that go with it, okay? A risk that could go with this strategy here is that you might get what's called pin risk. Okay, because remember, you are saying you're going to buy the shares at 655, right? If it goes below 655, you're going to buy the shares up here, okay? The problem that you're going to face with this is that what happens if SPY closes in between these two right here? Because you're basically telling you're going to buy these shares here, but then your put option is going to expire worthless. So you get what's called pin risk, which is a big problem that you might face with option strategies. If it gets very, very close to your strike, this would be an example where you just have to close it out and probably just take the loss on this one. Obviously, your risk to reward isn't that high right now because this trade is very unlikely to happen, as you will see. You have a 25 delta in this case here. So it's a very, very small, it's a less likely chance of this becoming profitable for you, but you can trade SPY options with as little as $100. Now, the thing to remember is that you do have to be cleared for options level 3 trading on Robinhood, and I think it's also Webull as well, and other brokers. You have to actually be approved for this trading strategy here. You can't just do it, when you just log in. You have to be approved for this advanced level trading because you're doing 2 legs at once. You're selling an option, and then instead of having the cash collateral for it, you're using this as almost like that collateral as well, and so it becomes a little bit more of a riskier strategy. And again, the pin risk could be a big problem here. So that would be a way, as if you like to be the one to collect passive income, you can get $17 out of $100 here. So you put up $100 in collateral. Basically, if you go to continue, you will see that you put in, one contract here. You do it at, 0.17. You would hit review order. And what you'll see is that only $100 goes in for collateral here. The difference in the strike prices is their collateral that will go in there. So you have $100 put into collateral, and you'll get paid out $17 as a result. Now, if SPY doesn't go to 655, you just made 17% ROI because you made $17 out of 100. Obviously, your risk is that you might lose, the $83 as you see down here. You might lose this $83 here, which is not obviously the best risk to reward. Okay. Now, besides doing this on the put side, you could do this also on the call side if you want to be like, I'm bearish on the market. So say you're bearish on SPY. You're saying, I don't think SPY is going to go above 700. People are saying 700 is like a good number. I think that SPY won't go above 700 here. So you're going to sell a call option here. Again, you'll get paid out $472, but you would have to have the shares to get rid of if you get exercised, which you don't have. So if you buy the strike price above it, you would be able to use that instead as almost like your collateral equivalency, as you'll see here. Again, the difference in the strike prices is $1, so it'd be $100 there. You're going to get paid out $33 here, so your max loss is $67, and you get paid out $33. And as long as SPY doesn't go to 700, you make 33% out of the $100, which is very, very nice money still. Obviously, again, this is a risk 1. This is a risk 2 to reward 1. So not the best risk to reward ratio, I would say, for this case here. But again, you're the one who's collecting the money up front. So you're getting paid out as you wait for the stock to not do what you want it to do. And so that's kind of the idea behind the credit spreads. As you'll see, it comes up as a credit spread up here. Now, if you're someone that wants to be the option buyer instead, now the option buyer is doing the same thing, but instead you're going to be, hey, I'm bullish that SPY is going to go to 700 here. And then you just flip the 2 strikes around. So instead, now your risk to reward is you're risking 1 to make 2, which again is a call debit spread. You're being paid, or you're the one paying up front that $33, and you're hoping that it moves to $700. It goes to 701. You make, $67 here. So risk 1 to get reward of 2. Now, just so we're clear, this is not the only way you can trade these spreads here as $1 spreads here. You can do it however it is that you want. I just want to say that you could trade SPY with as little as $100, which you can. One thing that I really liked that I was talking to Ryan about on our live stream, make sure to take a look at that memberships here. He gives some good advice. He usually is somebody who likes to buy a 40 delta, and then he wants to sell usually a 20 delta. Because a 40 delta basically means that there's a decent chance it could happen. It's not guaranteed, but it's a decent chance of it happening here. So then you would sell the 20 delta because that's less likely to happen in this case here. Now, what you're going to see is that it's going to create a much bigger spread. So maybe I might even just sell the 700 one just because it's a 27 delta here. So what you might see here is that this one becomes more expensive. The width here is $10, which would be $1,000 for a spread here. You're getting paid out you're going to be paying $427 up front to make $573, which again isn't the most ideal situation. Usually you want to do let's try to do the 705 for example here. So 705, you're basically risking 1 to get paid out almost 2. So that's a trade you'd be looking at doing in this case here, where you're able to increase the widths of your spreads. It's obviously going to cost you more the bigger the width is going to be. Now, with stocks like SPY, for example, like ETFs, there's a lot more liquidity here, which is going to make it easy to get in and out of trades. As you'll see, the bid-ask spreads are pretty close together, a lot of open interest and volume. So the bid-ask spreads are pretty easy to get in and out of, which would be very, very nice. Now, again, you're looking for SPY to have a max profit move about 3.7%, but even if it moves, about 3% or so between now and next month, you're looking at still some decent profits here overall. And again, you can always take profits early on these kind of trades here, which is something that's very, very important to know. So those are debit spreads. You can do credit spreads. You can do debit spreads. They are advanced level trading strategies here. You can do the same thing with like NVIDIA, for example. If you want to go for NVIDIA and go to trade options, as you'll see here, we're going to go, maybe you want to go a little bit farther out. Maybe you want to go to like June, maybe. Why not? You're like, you know what, Fridge? I'm pretty bullish on NVIDIA. I think the market's going to be doing pretty well here. Again, things that Ryan and I talked about here is that a 40 delta isn't a bad way to look at it, especially because you're looking for risk to reward, right? And I believe he said that was Tasty Trade, I believe, that made that recommendation for spreads. But basically it's because you're not paying a lot up front, but your risk to reward is there, which you want, okay? You don't want to open up a trade where you're risking, $1,000 to make $100. You don't want something like that. You want a good risk to reward. So the 40 delta for NVIDIA might be the 775, and then you're going to want to maybe say, you know what? I don't have I can't afford that kind of contract here. So let me sell the 210 one right here. And this right here is a risk 1 to get a little bit over 2 out, which again creates this call debit spread. You can do the same thing for credit spreads and just invert it where you're selling the short leg and then you're buying the long leg as a result. Either way definitely works. This one will cost you about $400 up front here, which is not too bad. And you have if NVIDIA goes up 15% between now and the June 18th, great, make some good money on it. It's absolutely amazing. For these trades here in particular, I would be curious to explore more of them, but more on the leap side of things. Like if I want to go to December of next year, I'm just curious to see what it might look like here. The liquidity may be the problem, but a 40 delta would maybe put you at like a 250. And then maybe if you wanted to go the 40-20 route, which again, not always recommended in this case, maybe if you want if you want like a 300 here? You're risking $900 to make $4,000, but NVIDIA has to go up to $300 between now and December of next year. So you can play around these trades as much as you want to in this case here, but you're looking for a big move to the upside for NVIDIA in this case. But it's a strategy that you could definitely do instead of just buying a farther out, leap option here for $2,500. You can only pay $900. Obviously, it caps your upside, but it also reduces your cost basis. And again, you can do the same thing. You can do credit spreads and flip-flop them if you want to. I think if you're going long-term leap plays, I think debit spreads would be better positioned that way because you want the stock to move with you. And you don't really experience much decay. The theta decay, you don't get as much of that until the last 30 or 45 days usually of selling options. So you'd be waiting, 500 and something days before you see that decay really kick in. So if you were to look at trading a stock like NVIDIA for long-term, and again, you can't afford those bigger leaps, nothing wrong with doing, hey, let's buy a leap option. Oh, I can't afford $2,500, Fridge. Okay, so let's cap our profit at say 300, for example. And that's where you still get a cheaper cost basis and you get a very good return if it goes up to $300, which, again, that's almost 2 years out for NVIDIA to go up to 60%. It's had crazier moves. I don't know what it's done in the last year. I'm actually curious now to see in the last year, what's NVIDIA done? Last year, it's up 85%. So, you're looking at over 2 years. You're looking at almost 2 years out in this case. So the thing you have to remember, though, is you want to pick it with stocks that have a lot of liquidity. Because especially if you want to be filling 2 option legs at the same time, you really want to get good liquidity there. Otherwise, it could be a problem. You could do this even with super cheap stocks. I'm trying to think about one that might be a super cheap one. You could do it for $50. I've seen a couple trades where you could do it with as little as $50. I'm trying to think off the top of my head which ones that could be.
off the top of my head, I can't think of. I know like Webull is one of them. I showed an example with. That was a long time ago. I made a video about Webull in this case here. Webull's like $5 now. If you can't afford that, then I don't know what to tell you. But just as an example here, you really could if you really wanted to. If you wanted to do like a leap option for January for Webull, you can't go that far out actually for $50. But say you were bullish on Webull, you can't even go that far out. Jeez, come on, Webull, what are we doing? May 15th? Nope. You have to go like super short term, it looks like. That's annoying. This would be an example of one that you could do where it's going to cost you, $50. Actually, this will cost you $12 for this debit spread here. And your profit would be 37. So you're risking 1 to make 3. Which is actually not even that bad of a trade, actually. So if you have a super small account and you want to risk $13 for Webull to go up 10% in obviously 8 days, which is very, very unlikely to happen unless you get a squeeze for it. But this is not a good example. This is just a random example to show you. But you can go as little as $50 for these trades here. It's just usually more of those like smaller stocks that you might be seeing in that case. There, I think like Marathon is one of them. Maybe let's see. Let's take a look at Marathon, which is crypto. Yeah, you can do it with Marathon. You can do it on the monthlies. That obviously makes sense, Fridge. But say you want to buy the $10, then you want to sell the $10.50. Like you're risking 19 to make 31, for example. And again, your cost basis at worst case is you're gonna be spending 19 to make 31. And Marathon needs to go up 8% in about a month. Which, again, it is possible because, obviously, Bitcoin and stuff like that. So, anyways, there's so many different trades you can look at here. I don't have time to go over every single thing here, but these are called spreads, okay? Long story short, how spreads work is that you're either being a credit spread investor where you're selling an option and buying another leg to kind of counteract it a little bit as, like collateral almost in a way. Or you could be the debit spread side where you're paying up front, but if you can't afford the entire contract, you can sell a longer leg option and offset your cost basis that way as a result of it. If you're going long term, I think debit spreads would be the play. If you're looking at short term, I think credit spreads would be the play. That's just my 2 cents of looking at things here. But that's how spreads work. You could trade major companies with as low as $100 to $200, which, again, is nothing compared to what they're trading at in terms of their actual share price. The Iron Condor, you do need to have advanced options trading approval. You can't just trade it when you make your account. You're like, oh, I'm going to trade the Iron Condor. You have to actually get approval for it. Now, how the Iron Condor works, and I'm going to do an example here with the S&P 500 with SPY. For the Iron Condor, you are basically looking at opening up 4 legs of a contract at the same time. So you're going to have some puts, some calls, all that kind of stuff. We're going to go over an example here, so do not worry. And the idea behind it is you want to make sure you're doing it with stocks that have good liquidity. Because if you don't have good liquidity, which we could probably pull up one and show you guys, it may be hard to get filled at a price that you want. So here is the S&P 500 SPY ETF, as you will see here. We had a nice actual week here, up 4%, which is actually amazing. So this would have been an example of when the Iron Condor would have gone against you probably, because again, it's a neutral strategy. You're basically looking for the ETF or the stock to basically trade sideways the entire time, and then you're able to collect passive income to get paid up front for it as you wait for it to expire. You wait for theta to kick in and all that kind of stuff there. So what you would do is you go to trade SPY options here, and again, it's kind of taking the ideas from last video and the 2 separate ones and basically putting them together. So you're basically kind of just saying, like, I want SPY to trade between this price point and this price point, and that is it. All right. So what you might be able to look at in this case, and again, you can go, 15, 30 days out. Again, I'm not going to be the one to give you the end-all, be-all strategy, what to look for. This is what I would do for an Iron Condor. And again, this is not financial advice. So please do your own research for it. You can be aggressive. You could be less risky. There's all different ways you can look at trading strategies here. And again, this is just the basics to it. There's a lot more behind the scenes. And if you're part of the Kingdom Discord, you would see that because we have somebody in there named Anne. Anne is someone who's a big financial trivia lover, and she trades a lot of Iron Condors and has made a crap ton of money. So shout out to you, Anne, if you're watching this, because you are an amazing trader when it comes to the Iron Condor from what I've watched. So what you'd want to do here is that you would want to go ahead and say, I think that SPY won't go between now and May 15th. I think SPY won't go to, let's say like that $700 mark, for example. So I think SPY won't go to the $700 mark. And again, you can do this with indices as well. And going back to what she does it with SPX. So there's no after hours possibility of assignment. Again, when you're selling options, there's that possibility of assignment and everything else. So you can do this with indices if you want to, or just stocks if you want. It's kind of up to you and your preference, obviously, at the end of the day. With indices, though, it might cost you a little bit more in terms of you can't trade it. Isn't like the cost or the risk or how much money you could lose with SPX is a lot more because it's a lot higher of a price. We can do an example of SPX also kind of show you. So I always do SPY because you can do it in as little as, a $1 difference in the strike prices here. So let's say you want to sell the 700, saying like, I don't think that SPY will go past $700. It's a 26 delta, which is not too crazy in this case here. And again, the problem with this is that you don't have the shares to offload. It's like naked call option. It's almost like a covered call, but you don't have the shares for it. So again, as we did in the last video, you say, okay, you know what, Fridge, I'm going to buy the 701, and that's going to basically cap my, my profits here because it's going to offset how much I'm getting paid out, but it also is going to limit my max loss. As you'll see, without this contract here, your max loss would be unlimited in technicality, but you have a big loss if SPY breaks that and goes up to, 715 or whatever, because you obviously don't have the shares to give. So you would buy the 701 call option to make, again, that call credit spread. We made a video about that yesterday at the time of recording this, so take a look back at that if you want to. And so what you're going to see here, and you know what I keep doing? Whoop. I got to do this every time now because I keep forgetting on what in the crap we're doing here. And I got to show I want to show the nice little chart there. So again, we've got a nice delta 700, a lot of open interest and volume here. Bid ask is very, very nice, which we're happy to see. And basically what you'd be getting paid, you get paid $31 here. Max loss would be $69 here. So if SPY goes to $700, then you would be able to collect almost max profit of $31 in this case, where your max profit is at $700, and anything after that, you'd be losing a little bit of money. So that would be the call side. But again, you're saying, well, Fridge, I don't know what direction is going to be, but my thought is that it's not going to move much in either direction. So basically what you could do is you have a call credit spread, and then what you could do is you can go to the opposite side here, and you can create a put credit spread as well. So say, again, I like to go with nice numbers here. Say it's like, maybe a 650 delta, for example here. Again, this is not the exact, perfect strategy to build out here in this case. But say you want to sell the 650 put option here, again, hoping that it won't go below 650, and you want to buy this one to again to give you guys that little bit of collateral here in this case here. So you'd buy this one, and as you will see, it creates over here on the side here what's called the iron condor. So basically what it's saying here is that SPY has to basically trade between 650 and $700. Right now it's at 680. So it's not like perfectly centered here, but what the focus here is that you collect $45. You would collect $45 of passive income. And as long as SPY trades sideways between here and here, between now and May 15th, you would collect $45, and then your max loss is $55. So what you're looking at here for this kind of trade here is you're looking at almost a 1-to-1. You're risking, 55 to make 45, almost a 1-to-1 risk to reward ratio, which again is not a, the worst strategy to do in this case. You could sell options and get, risk 1 to make 2 or whatever the case is, but 1-to-1 isn't too bad in this case here. So really happy to see that that's how you can build your iron condors, for example. Now you don't have to do $1 spreads, as you could, if you wanted to, make it where it's a $5 spread, so 650 to 645, for example. Obviously it's going to allow you to collect more premium because you're paying less for this 645 contract here, for example. You're paying a lot less for it. But what it's going to do, and we'll do this on the call side as well, what it's going to do is it allows you to essentially collect more premium up front, but you get a little more of a risk to it. So now if I go $5 spreads here, I collect $211, which is very, very good premium. But now my max loss is $289. I've kind of just, multiplied my values up because I made the spreads wider. So making the spreads wider, that's kind of what your goal is going to be, is that you're going to be looking to collect more passive income, but you got to be worried that, hey, it starts to get closer to the strike price here. You may have to close it out for a loss. So 647 and 702 is your break evens here. So you can definitely do it that way if you want to. If you wanted to go like super, Obviously, the more risky you go, the more risk to return there is in this case. And a lot of people can trade these in different ways. The thing that sucks right now, obviously, with the markets is our Middle East conflict we have going on. There's a lot of volatility, so all it takes is one announcement, and the market's going to go up 1%, down 1%. So there's a lot of, a little bit of problems that could be happening with that. So you got to be kind of a little bit on the cautious side here. For that reason. But the closer you do get to your, share price for these kind of trades here, the more risk to reward ratio you're going to have. Obviously, it's more risky because you're basically pinning it to a very, very small region. But if it does work out that way, you make a lot of money as a result. For example, if you were to make one literally at the money, which I think would be a crazy thing to do, but if you did, you get paid out a pretty hefty amount of money here. As you will see, you get paid out $99 and your max loss is $1. Why? Because you're telling me that SPY has to basically trade literally sideways between now and May. And that we all know that ain't happening. So obviously, as you get closer to your share price, the risk reward is going to be a lot higher. So you got to kind of figure out what's a good sweet spot for you. Some people might like to go like a 30 delta maybe. So we could probably even do a 30 delta, and I'll go over to SPX and show the same thing here. Again, the thing that you have to be worried with these is, like I said, with credit spreads from before, is your pin risk of getting pinned in between your strike prices. So just keep that in mind as you're, doing these kind of condors here. So if I did like a sell, a 697, and then say I wanted to do just keep it nice and small here. So that's a 30 delta there. So again, you want to kind of find that sweet spot where it's a good risk to reward in this case here. What's the 30 delta the other way? Let's take a look. 30 delta the other way is like a 663, and then you'd buy the 662. And so this one's a little bit of a better risk to reward. You're risking one to make 1.5 almost. So, not too bad. Obviously, 30 delta isn't too bad. All it really takes here, though, is you got to make sure you're managing your position carefully. Now, earlier in this video, I said that you need to pick it with a stop that has high liquidity, because the liquidity, your bid-ask spreads are going to be super crazy if you don't have high liquidity. There's not a lot of options being traded. So that's something to keep in mind about as you're doing it. For example, I'm trying to think about a stock that does only monthlies here. Like NVIDIA obviously is very liquid. Apple, the Mag 7s are very liquid for this, so you probably will have an easier time doing it in that case. But if you were to take a stock, I'm trying to think about what's one that may be like that. The one that came to mind, I don't know why, was Stanley Black & Decker. I don't know why. That's probably because I traded it recently. But if you notice here, when you go to the options chain already, it already only trades in the monthlies here, as you will see. It already trades in the monthly positions, the monthlies, not the weeklies. So it means there's less liquidity already. So even if I wanted to say, I'm going to sell, 80 and then buy the 82.5. Again, as you'll see, this isn't $1 increments, it's $2.50 increments here. And I want to go the opposite way and say, all right, I'm going to go with the 65 and then the 62.5, whatever it is. Again, this one isn't even a bad risk to reward ratio. It's almost a 1-to-1 here. But if you take a look at how wide your bid-ask spread is over here. 20 to $1.85 or 20 cents to $1.85. That's a really, really wide bid-ask spread. And if you put in, like 80 cents just to get filled, that's going to be a problem. So you want to make sure you're doing it with stocks that are pretty liquid, because otherwise it's going to be hard to get filled out and you're going to lose some money potentially just on that as a result. Again, what Ann does a lot with the SPX, the index you see here. This one you can only trade options with, you cannot buy shares. And so that's something to keep in mind about as well. But as you'll see, each strike price is a $5 increment, even for a 2-day expiration. So this one's going to cost you a little bit more because it's already $5 increments, or your potential loss is going to be more because it's in $5 increments here. The big difference, though, with SPX versus SPY ETF can move after hours. This one closes at 4 p.m. So if your Condor closes at 4 p.m. Eastern time, in between your strike prices, you're good. There's no risk of a big move after hours, of an announcement happening where stock is going to move, where the ETFs are going to move a lot after hours. There's none of that happens for this index here. So it's kind of a nice little trade-off there, even though it does cost you a little bit more. But, so if you're looking at doing one, obviously this is like a shorter dated one here. But again, if you wanted to do, like the 30 delta here, 6,850, 6,855. Again, as you'll see, it's already a $5 spread difference there. It's about a 30 delta. And then you go down to here. Again, these are not the numbers I would always use, but just something to play around with it a little bit. 680 and then the 675. As you will see, your risk to reward actually isn't that bad. You're risking $200 to make $295 as long as, SPX trades between basically 0.5% in either direction on Monday, on April 13th. So that is your idea behind your iron condor. And again, it does pop up and tell you that it is literally an iron condor, which is nice to know. So you're looking at an iron condor trade. And again, making sure that you're getting the liquidity fill is a big thing to get filled for these contracts here. So keep that in mind also. As you will see with Robinhood Gold, you do save a lot of fees because if you don't, there's a lot of fees. There's a lot more higher fees that come with indices compared to the ETF. So there's pros and cons to both, obviously. Again, for me, if I'm doing a small account, I'm trading iron condors. I'm probably going to do S&P 500 maybe, only because that is, it's a little bit, it's cheaper. It's easier for us to do. When you were to put out this contract here, and again, this can't go in because obviously the market is closed. You do still have money that goes aside for collateral. I forgot to mention that earlier. You do have money that goes aside for collateral still, no matter what. So make sure you have money aside for that one. And again, nice little order summary here you see here. And so that would be, again, your collateral would be $500. You get paid $291, and obviously, if you get pinned, if you get assigned, whatever the case may be, then obviously you take, your collateral minus your credit gives you your max loss, which you will see is down over here. So that's the idea behind the condors. Again, it's very good if you're looking for SPY, SPX, NVIDIA, Amazon, Apple to trade sideways the entire time. If you're looking for big moves, though, you don't want to do iron condors because these are limiting your restrictions here. So keep that in mind. Now, as someone who's the option seller, you kind of want to look to see if we get a little bit of a bump in the implied volatility. Because to get a little bit more of that implied volatility, you can really take some good advantage of certain stocks if you have a high implied volatility. For example, if you want to do this on like earnings could be a good potential play for this to do. Because if you get IV crush, if you're saying that, hey, I'm betting for this stock to trade between here and here, and the earnings come out and like nothing crazy happens and it trades in between, you get some very good premium as well. So the iron condor may not be a bad strategy for earnings. Obviously, keep in mind that you could get assigned though, so keep that in mind. But if you set your legs up appropriately, you may be able to make some good money there. So that is the advanced strategy. Again, not everybody's approved for it. You have to actually, fill out their approval form on their brokerage account. Make sure you fill it out and make sure you apply for it. So that way, if you get accepted for it, you can trade iron condors. And so that is basically the idea behind this is you are basically buying multiple legs of a stock on the options chain, of course, and you're hoping that there's going to be some sort of move in either direction. So, for example, I know we have some earnings coming up with big stocks. NVIDIA is actually towards the back end of earnings usually every single year, so maybe we'll actually not do it. Maybe let's mix it up a little bit. Let's do I don't know. Let's do Amazon or actually Tesla. Tesla moves a lot. Because, everybody talks about Tesla, excuse me. So when are Tesla's earnings going to be? Tesla has their earnings April 22nd after hours. So about 2 weeks out or so. So April 22nd. So maybe we'll go like April 24th. So let's say that we're looking at Tesla, and we know that Tesla likes to move, obviously, at their earnings, 5%, 10% maybe, depending on what they announce, depending on the earnings calls, that kind of stuff. But you're somebody who's like, Fridge, I'm thinking, I want to buy a call option. I really do. I want to bet that it's going to go higher up in this case. I want to bet we're going to get a big move to the upside here in this case, which your big move here would be looking at a contract that would cost you $1,200 here. And if Tesla goes up about 4% or so by April 24th, 2 days after earnings, you can go a little bit further out if you want to. Maybe you want to go till April 27th and you want to buy this call. Oh, you can't even, is that going to pop up on here? Wow. Oh, they're kind of here, but not really. Let's go back to the 24th one. Why not? But Fridge, I'm paying, $1,255 here, as you'll see on the side over there. I gotta do this again. Hang on, ready? Let's go for a ride. Woo! I do this like every time now, and I feel like people think I'm like stupid as ever. I promise I'm not that much of an idiot, guys. I promise I'm not stupid. But so anyways, back to what we're talking about here. If Tesla goes up, about 4% or so between now and April 24th in about 2 weeks, then you'll be able to print some very good money here, as you know. But people might sit there and say, well, Fridge, what else can I do instead? I'm not sure what direction. It might be good, it might be bad. Earnings at the end of the day are coin flips, right?
Earnings are coin flips that we're looking at here. So what somebody might do is say, you know what, Fridge, I'm going to buy a put option as well. Same expiration date, and I'll even buy the same strike price. And what this creates is what is called your straddle, because what you're basically doing is you're buying two legs. You're buying two contracts here. Two. Okay. As you'll see, your max loss is $2,820 here. And you're basically betting for Tesla to have a move in either direction. Now, as you will see, your expected move to make money on either side now is not 4% now. Now it's 7-8% because you're paying for two contracts instead of one, right? Which you're paying for two contracts, it's going to be a little bit more for you to break even. In this case, you need more of a move in either direction. But the thing that you're seeing here is that it allows you to basically kind of, cover both sides. If Tesla goes up 5-10% after earnings, great, you make some good money here, as you'll see. If Tesla goes down 10% after earnings, great, you make some good money here. Now, the thing to keep in mind about when you're doing these kind of trades here, especially for straddles and strangles as well, is that you want to make sure you're buying these out far enough where you don't have to pay a very high premium for the trade. By that, I mean, as we get closer to their earnings report, I wouldn't be surprised if we see this trade worth a lot more. In fact, bookmark this right now. This trade will cost you $2,821 right now at the 352.5 strike price. Okay? It'll cost you $2,821 right now. As you get closer to earnings and the speculation builds, the unknown, the fear, the uncertainty, the FOMO all starts to build up here, it creates this IV expansion, which probably is going to make these contracts worth some more money here. The IV right now is 53%. It could be a lot higher right before earnings. So that would be something to kind of think about. And if Tesla starts to sell off a lot, it's no big deal. You're going to start to make some money on one side or the other. You just don't want Tesla to basically trade sideways at this point because you won't make any money. But if you get a big move to the upside or to the downside up to earnings, you'll still be able to hopefully print some very good money here as a result. And what you could do if you wanted to go super crazy, if you start seeing some bullish momentum, you could close out one leg and just keep the call side going or vice versa. Now, the big difference and the only difference between a straddle and a strangle is this. So instead of buying this one right here at the same strike, I'd buy one that's a little bit different. And it creates what's called a strangle instead of a straddle. That's the only difference. This right here is your only difference, is the strike prices are different in this case. But Fridge, why would I do that? Well, what you'll notice is that your break evens are a little bit higher up, not by much, but your cost basis is a little bit lower. Instead of it being, $2,821, I'm saving you essentially, $150 or so by doing a strangle instead. Now, obviously, what you could do, instead of doing at the money ones like these, what you could do for these trades here is you can go a little bit farther out, so it costs you less. You just are going to be expecting a little bit of a bigger move. So if you want to do, say, the 340, for example, and then do the 365, you still get a strangle in this case here. Obviously, it's going to be a lot cheaper, but your break evens are going to be a little bit higher as a result. As you'll see, it's a little bit more than 8% now instead of 7% like the previous one was. So that's something to kind of keep in mind about as you're looking at these kind of trades here. So that's the real difference between the straddle and the strangle. The straddle has to be at the exact same price. Whether you want to do, a 345, buy a call and buy a put at 345. That's obviously still going to be a straddle here. It's going to be about the same price. But this one, buying this one here, as you'll see, favors a little bit more on the call side. So it's kind of like a cautiously bullish outlook you see over there. It's a that way. It's kind of a cautiously bullish one where you still have the downside protection a little bit, but you are still hoping more for Tesla to go on the upside. Again, the big risk that you have with straddles and strangles, you're paying 2 times as much, obviously, for contracts. It's going to cost you twice as much. So if you can't afford it, obviously do not do it because you can't afford it. You don't want to blow your portfolio. And if Tesla gets IV crushed and you're just stuck staying right at around the strike price it's at, or the share price, that's where you lose a lot of value really quick. So if you're looking at doing these kind of trades here, I would say maybe go a little bit farther out than just right after earnings, for example. Maybe going to a May 8th, maybe. I don't know if the option. Oh, here we go. So you do a May 8th one here. Obviously, it's going to cost you a little bit of money to do the 355. It's a little bit more. Obviously, you pay more because you have more time on your side. You're paying for more time in this case here. But you're looking for
you gave yourself an extra 2 weeks of Tesla to move in either direction. Because what you might see for earnings a lot with companies is they get the big move the day after, and they have continuous selling pressure after that. They read more into the earnings, and it can be the same thing for the other side. You have a big move to the upside, and you can have more and more, positive bullish catalysts coming out. You get a lot of banks and analysts, revising their estimates. You might get that bullish momentum, and you can ride it up to the upside as well. So there's definitely a lot of plays you can do in this case here. Now, some people might sit there and think, what if I buy an in-the-money put and an in-the-money call option? What would it look like? And honestly, I don't really know. It's a good question. So let's say that I want to buy an in-the-money put option. Again, when you buy in the money, you don't have as much of a break even. So say I buy an in-the-money 380 put option. I'm looking for a very, very small side to the downside here. And say I want to buy an in-the-money call option here, as you'll see right here. It still creates, in case it's called a custom one, which I guess is different than your straddle, which I didn't really know much about in this case. But it looks like you're still going to get you're still paying 1,000. Oh my God, this is because it's like a weird thing. I wouldn't even play with this. No, thank you. That's not for me. This is Straddle and Strangle 101. That is just like some craziness. I don't even know what you even call that one. I don't even worry about it. But again, let's go back to the basics. The basics are, for companies like Tesla, for companies like Amazon, for companies like Google, like those kind of companies that you're looking at here, you're looking at having those big IV moves in either direction. This is where a straddle and a strangle pays off. One company that you could really do well with, what's a company that's done really well? I don't know, when are SanDisk's earnings? Because I'm curious to know. They're going to be paying a hefty price for these. SanDisk has their earnings on April 30th. So we can go a little bit, and this is going to be a lot. I'm not going to sit there and sugarcoat it. This is going to cost you a lot of money. But again, if you're looking for a big break even here, in this case, you want to create, a crazy straddle, as you'll see here. It's going to cost you 20 G's, of course, which is crazy. But as we'll see, your SanDisk implied moves here are expected to be very, very large. One thing that I know a lot of people love to do, especially for earnings season, which again would be like May 1st for here, is to buy a put and to create the straddle at whatever their strike price is at. So, the 860, for example, or the 855. And it gives you an expected, not perfect, but a rough estimate as to what the market thinks the move will be. So right now, SanDisk they're looking at their pricing in earnings, post-earnings, or a move between now and May 1st of about 22% in either direction. Big move. I don't know what the expected move is for their earnings, but that's what some people have loved to do, to use straddles and strangles, is to kind of figure out the expected move from it and use that as your guideline. So that is it for today's video. Again, straddles and strangles are very useful if you're looking to capture some IV, especially if you're looking for a big move. For example, doing a straddle when the deadline was coming up for the S&P, I think would have done very, very well, because again, there's a lot of IV baked into it, and when that earnings came out, it was a 2% move in SPY and the Qs and stuff like that. So you could do it on, big events like that, maybe, for example. Earnings is a big one as well, but you want to get in far enough ahead of time, because as you get closer and closer to a specific event, whether it's CPI data, whether it's FOMC meeting, whether it's interest rate decisions, whether it's earnings reports, when you get up to that date, it's probably going to be a very hefty price that you would have to pay out to take advantage of the move. So keep that in mind as you're doing these kind of trades here. It is really risky. And again, you're buying two options instead of one, so your cost is going to be twice as much. Thank you guys so much for watching. If you made this far in the video, as always, make sure you like the video, subscribe to the channel, turn on those bell notifications as per usual. Hope you're making money in the market in some way, shape, or form. And as always, I will see you guys in the next video.